Hello and welcome to the latest episode of On the Money, a weekly look how to get the most out of your savings and investments. For this episode, we're going to be discussing the good, the bad and the ugly of stock market takeovers. Joining me to discuss this topic is Ken Wotton, who manages various funds, including Strategic Equity Capital Investment Trust and open-ended funds for Gresham House. So Ken, to start off, could you give an overview of M&A activity at the moment for the UK market? It does feel like it's been picking up over the past 12 to 18 months. Does that ring true? And does the potential uptick in bids from potential suitors show how cheap some UK companies and UK sectors are?
Thanks, Kyle. You're absolutely right. The M&A activity that's been present in the UK equity markets over the last 18 to 24 months has really been elevated. And I think the main reason for that has been following the change in the interest rate environment, the kind of economic shock that we saw the back end of 2021, early 2022. And after that had kind of settled, you had what can only really be described as an exacerbated effect on valuations of UK listed companies on top of what had already been a period of underperformance since the 2016 referendum result. So you had a whole host of UK listed companies, particularly at the small and mid-cap end of the market, trading at very substantial discounts to their international peers, to their own history, and importantly to the valuations that you could see for transactions, M&A transactions that were happening in private markets. So all of that pointed to essentially a valuation arbitrage opportunity. If you were either a private equity firm or a corporate strategic buyer, you could find high quality businesses at much discounted prices relative to what you would have to pay if you were buying them and they were private. And it started off at the smaller end of the market because you've seen discontinuities in the debt markets for private equity transactions, which initially were subduing the larger transactions, but actually that started to be alleviated and you start to see some larger transactions in more recent months. So it's not really specific to any particular sector. It's across a whole host of sectors. It's not really a particular type of buyer. So it's UK private equity, it's US private equity, it's European private equity. And there's also strategic corporate buyers from all sorts of jurisdictions. So it's the one consistent factor is the low valuations of good quality UK listed companies.
And over that 18-month to 24-month period, which takeover offers, whether they were accepted or not, caught your eye? Which ones stood out for you?
Some stood out to us because we were sort of, well, depending on your perspective, beneficiaries or recipients, at least, of the offers. So one that was a very good outcome from our perspective for our Strategic Equity Capital PLC fund investors was Medica Group, which was a transaction which completed during the summer of last year. And Medica is a business, it's focused on teleradiology, so it's playing into the theme of sort of outsourced pharmaceutical services, and it was selling into health services, particularly the NHS, but also into pharmaceutical companies supporting clinical trials for new drugs. So it's a really interesting area. It was a business that was growing strongly, double digit. It's an international business. But because it was a UK listed company, trading at what we felt was a very undemanding valuation multiple. And we knew that particularly because we could see that there were two of its direct competitors that were both private equity backed businesses that had transacted through a typical private equity auction process where the business was marketed for sale and then ultimately sold with an investment bank advising the process. And we could see that those businesses had been taken out on multiples that were almost double the valuation multiple that Medica was trading at. So we could see this really stark example of this valuation sort of discrepancy between public and private markets. Medica, fortunately, we were a large equity shareholder in because we had very high conviction in the opportunity there and the valuation. And across our various funds, we had a 20% equity stake in the company, which meant that when there was a potential offer for the company, they really needed our sign-off for that to happen because we could potentially have blocked the takeover if we voted against it. And equally, if we felt it was an attractive offer that gave us a price which reflected the future opportunity and without the risks of execution that go along with that, then we would be an enabler of that transaction to happen. And that's the latter which did happen. So the business was very well advised with proper corporate finance advisors on retainer to help them. And that deal happened at a valuation multiple, which is pretty much exactly in line with where those two other private competitors were taken out. So we knew it was a a well-tested and validated price. And as I said, it gave us the opportunity to realise our large stake at a price which we felt was a good sort of combination of discounting the future opportunity for growth of the company, but also sort of removing the execution risk, or at least transferring that to the new private equity owner.
So do you do that with every company that has a potential takeover offer? Do you actively get involved and you provide counsel, or does it depend on your stake in the company?
Yeah, it really depends on our stakes. I mean, we obviously are very willing to offer our counsel to any of the boards and management teams of the companies where we are investors, but where we're a small shareholder, then obviously that voice is a bit quieter than it would be if we were the largest shareholder, like we were in the case of Medica. So where we have really high conviction in a business and where the valuation really stacks up, the strategy of our strategic equity capital investment trust is to take larger equity stakes in a select number of businesses and then to proactively engage with the management and the boards of those companies to support value creation in whichever way we can. And in the case of a takeover, for us, that's about making sure that if that does happen, it happens at the right price, not the wrong price.
And how frustrating is it when you get it at the wrong price? You know, you can see the long-term potential in a company and a private equity firm, for example, comes along and gets it on the cheap.
Yeah, I mean, that is definitely a frustration. So, I mean, I often get asked about the takeover activity and are you unhappy that sort of companies that you like and that you've backed with a long-term view get taken off the market prematurely? And the answer is really it depends. It depends on ultimately, it depends on the price and our view of the prospects. And in some cases like Medica, we view those things and the balance of that is that we think a takeover at a certain price is the right thing for our investors. And in other situations, it's frustrating. And if we're a smaller shareholder, we're less of a position to be able to do anything about it. So a good example of that quite recently was a business called Alpha Financial Markets Consulting, which we were a medium-sized shareholder in. So we weren't the largest holder. We had a sort of single-digit equity stake, but declarable. It's a consulting business focused on financial services market, particularly asset management and wealth management. And it's been a good long-term performer. We think it's very well positioned in its end market. And importantly, it was a company that was being driven in terms of the demand for its services, not by the direction of markets, but by consolidation, regulation and change within the asset management sector, of which there's been a lot. So it's a business we thought was well positioned. We had actually been trying to buy more of the shares on the back of a profit downgrade that they'd had, which was a market-wide factor in terms of the consulting sector, where there's been oversupply of consultants and therefore some pressure on pricing. So the company had a downgrade. Shares had overreacted in our view, and we'd started to build a bigger stake. Unfortunately, before we'd managed to complete doing that, initially there was a leak and there was a press announcement about a potential private equity interest from two different private equity firms in the business. And that subsequently became an announcement of a confirmation there was a potential offer and then a recommended offer from the board. And it's a strange one where the valuation multiple actually was quite attractive. So it was 14.5 times EV to EBITDA. So the multiple in standalone looked quite attractive, but actually, unfortunately, it was being applied to profits, which we felt was subdued due to sort of market factors which were transitory. And therefore, we expected, and the reason we were buying the shares was that the profits would recover quite strongly. And had the business then been sold on the back of recovered profits, you'd have got a much better price. So we only had a stake which was it was meaningful, but not sufficiently meaningful to be a blocker. We voted against the transaction because we saw sort of better value by holding over the longer term. But unfortunately, we were outvoted and it's ended up being taken private by a UK private equity firm in this case.
So are there any key ingredients that you think make a good takeover offer that, if it's a company you invest in and also would benefit other shareholders?
I think for us, it really comes down to the balance between the price and our view of the long-term growth prospects of the business and the risks that are attached to that. And it's as simple as that, really. And it's a judgment. So we, for all our investments, we will take a view on what we think the long-term potential value of that company will be. That's a function of what we think the profits will do over the period of our investment, what cash generation we think those businesses will make, and what multiple we're buying the shares and what multiple we think a sort of fair valuation multiple should be over the long term. And you weigh up all of those things and you consider the execution risk that is attached to delivering the profit growth that we're expecting. So you take a risk-adjusted review of it, and then we come up with a target price for that investment. And we'll discount it back to the present day. And that's kind of tells us whether we think the share's a good value or not. If a offer comes along that is at or in excess of that long-term target price, then all else being equal, we will be happy with something being taken over. And if it's a discount to our long-term valuation, then we will probably not want to sell. And we typically take long-term positions. So we're not interested in a 25% premium to the share price at the moment if we think the shares can double or triple over the next 2 or 3 years. So it's a sort of long answer to your question, but each situation is different. And it's really down to a combination of judging that offer and the price that it represents relative to the opportunity and the risk that we see.
And in terms of it being an unfavourable offer, obviously that would be if the price that's being offered, you think, is below or way below what the value of the business should be. Are there any other things that you think private investors should look out for in terms of it potentially being a bad takeover offer?
Yeah, I think the other thing, which we don't see that often, but occasionally you do see, especially at the smaller end of the market, is where there's shareholders that are already on the register that are involved in the transaction, or if it's a deal which involves the management team, and so there is a risk of a conflict of interest in that situation. And whilst the takeover rules do have sort of specific provisions around who can vote on transactions, which are designed to mitigate that, sometimes you have situations where you know that the management team are going to end up doing better on the other side of the deal than shareholders will, even if you can't sort of specifically point to particular bits of evidence about that. So I think trying to evaluate who's buying, why they're buying, and what the management and board's view of it is really important to try and figure out as well. And that sort of comes into our calculation of whether it's a good deal or not. But that's quite a nuanced view. And again, it's a case-by-case situation.
You've mentioned a couple of examples of M&A activity you've seen for the investment trust you manage over the past 18 to 24 months. What's been the most recent takeover offer?
Well, actually, that one, Alpha Financial Markets, has been the most recent one we've had in the portfolio, but we've had a few. There was 10 Entertainment Group, which is the number 2 10-pin bowling operator in the UK, which got taken private earlier on this year by a Dallas-based mid-market private equity house. So it's going to be an interesting transaction, probably a slightly unexpected buyer there. We've had Smart Metering System, which is SMS, which was taken private by KKR, so sort of huge global US private equity firm. And we've had other transactions like City Pub Group, which was a relatively small chain of independent or independently branded pubs in the UK, and that was an all-share or part cash, part share offer rather by Young's, which is another UK listed company. So some examples of a small private equity firm that most people wouldn't have heard of, large global firm, plus a UK listed company. So UK listed businesses are still participating in M&A as well, which is not just the private equity firm.
And coming back to where we started, so as mentioned, the uptick in M&A is a sign that it's not just been overseas companies, sometimes it's been UK companies as well, are finding value in UK listed companies. However, for me, the $1 million question is, when will investors start returning to the UK market? What are your thoughts on that? Since the Brexit vote, there's been a consistent level of outflows from UK equity funds. When do you think the tide will start to turn?
Well, I'll be honest, I've been surprised at how long it has lasted for, that sort of consistent data that we're seeing, fund flows out of UK equity funds and out of UK smaller companies funds in particular. And I've been saying for quite some time that this phenomenon of M&A activity and elevated M&A activity in the UK market is going to shine a light on the valuation opportunity, and in turn that will act as a catalyst for at least stem the flows out and hopefully start to see money start to come back into the UK market. That hasn't happened consistently yet, so it's taking longer than I thought. But I guess where the flows come from is not the main driver. It's if there are flows of capital seeking that valuation opportunity, then whether that's going back into open-ended funds or if it's coming from overseas funds, global funds that are sort of increasing their UK allocation relative, or indeed some of the sort of mooted policy support, such as the idea of the British ISA, which is now looking like it's defunct, but also the Mansion House Accord and specific pension fund reforms, which might attract flows back into the UK market for the pension fund sector. It doesn't really matter precisely where they come from, but if there are flows which come back, then I think you could see ratings move quite quickly upwards, particularly in the smaller end of the market. And if you see that, then suddenly you flip from businesses looking highly undervalued and therefore being really attractive takeover targets, and suddenly you get the opportunity, or at least the conditions for the IPO market to reopen again if valuations are sort of bit more sensible. So it could all move quite quickly.
You mentioned the British ISA. What are your thoughts on it potentially being scrapped? It's not been confirmed yet that it has been scrapped, but the press reports indicate it has.
Yeah, so when we put our name to being supporters of that initiative, we thought it was as part of a number of different potential policy support measures, it was a good idea in that it was going to be a way to stimulate more flows of money back into UK listed equities. But as I said before, it sort of doesn't really matter precisely where the flows come from or the mechanism. What matters most is that the flows do come, because that will be what drives valuations. So if it is indeed true that the British ISA is not going to be proceeding, then that's a shame, because that's one way of driving those flows. But I think ISA reform more generally is still on the table as far as I understand it. And you've got lots of money that's sitting in cash ISAs, for example, which is not being sort of put into productive British businesses. So there's a potential pool of capital there that could be tapped into. But there's lots of other kind of things there that are set in the offing to be discussed, and pension reform is another one. But it could just be global fund managers sitting in New York thinking, how do I de-risk my US equity exposure, which, you've got US markets trading at practically all-time highs. You've got the Magnificent Seven exposure, and I'm not going to make a call about when or if that stops. But if you're a global fund manager, you might well be thinking, I need to start kind of thinking about hedging that exposure, and actually looking at other markets you could put money into. We're not looking too bad, but notwithstanding the recent sort of anxiety and uncertainty coming up ahead of the budget. I think politically, economically, we're now not on the naughty step. We're a bit more stable than many other countries, and I think there's worse places you could put your money, particularly when the valuations are where they are.
Well, thanks to Ken, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to make the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.